Good morning, everyone. This is John Thomas, the Mad Hedge Fund Trader. If you can hear me, just put your first name in and where you're from, and I'll say hello. Okay, I see Matt from Columbus. I see Jill from Campton Hills, Illinois. Pam in Montana. Robert in Jacksonville, Florida. Boy, I bet you're getting a dump, Robert. I'm amazed you still have internet connection. Mark in Seattle. Skip in Panama. Nick in Halifax, David from Sunnyvale, Britt from somewhere. Let's see, Brian from the Fog Bank in the outer sunset of San Francisco. Yeah, well, it's clear where I am. Brian, somebody from Minnesota, Paul, Pennsylvania, Jim, Evanston, Illinois, Rick, West Palm Beach. Amazed all these Florida people are able to get in. Kurt from Michigan, Michael from Texas, Steve from Florida, Lake Hills, Illinois, and Cocoa Beach, Florida, Rhonda in Kentucky, and Don in Calistoga. Okay, let's get the show on the road here. Today's webinar is entitled "The Outlook is Cloudy," and it kind of looks like the view from West Palm Beach right there with all those black clouds. And why it's so cloudy, I'll get into it in a few seconds. First of all, a little bit of housekeeping. We have the Lake Tahoe conference, only 6 weeks off now. You can go to madhedgefundtrader.com. There will be a bar across the top of the website where you can buy your tickets. This is where our most successful clients come if you want to pick up some trading tips from them. It's a great place to do so, and the food and wine is fantastic. That I'll guarantee. Trade Alert Performance. Yeah, this is a section I'm really happy to talk about these days. August finished at 16.01%. And then on the first day of September, we brought in another 2.4%. That was the time decay on those options on that 3-day weekend. That brings our 2019 year-to-date to 36.74, compared to only 13% for the Dow average. 336.88% since inception, average annualized return of 34.30%. Current portfolio, we have 40% long in tech stocks and Disney. All of these are very deep in the money call spreads, and we have short positions in the Russell 2000 and Walmart in not so deep in the money put spreads. It's a high day today, but we still have plenty of room, and all of these, the entire portfolio expires in only 12 trading days. If it does, we'll be up 39.39% and in position to make it up to 50% by year end, maybe even more. Who knows, maybe we'll break the old 59% record. Here's what the chart looks like, and yeah, this is the kind of chart you dream for. This is the type you print out and paste on the wall and make sure all your friends and relatives see it, or at least your boss if you're in a trading house. Long-term return, again, big spike up there. Method to my madness. Inverted yield curve has caused recession fears to run rampant. Almost all economic data points are bad now. We get a couple of good ones, but the drift for the group is negative. New U.S. interest rates heading to zero or close to it. U.S.-induced China slowdown is dragging down the rest of the world. China is the world's largest customer. When you put it in recession or cause its economy to slow, that's bad for business globally. Possibility of an overnight trade deal is keeping short positions small, and that includes me. I'd be doubling up my shorts today if the risk of a deal, however small, is still there. Strong dollar adding to recession fears. We hit a new high for the year yesterday, wiping out emerging markets. Hard Brexit may be about over. There will be an election called in October. If Boris Johnson and the Tories are voted out, then that will bring Brexit to an end. The bad news is only if the socialist government gets elected, if Labour gets elected, but then they have their own problems like nationalizing the banking system again in England. 3 more Fed rate, 25 basis point rate cuts. I think there's a 50-50 chance they don't cut this month. If they don't, then that could cause a sharp sell-off. Oil's in free fall, gold taking a run at new highs, and clearly has 1600 in its sights. So get your questions in, and when I get to the asset class, I will address it. Okay, we have the market timing index still at the low end of 29. And what you usually want to see here is for this to chop around for a couple of months, really, around the 20 level or below, like we did here, to give a real solid buy signal. We're not there yet. My guess is we have one more swoosh to go, and then we'll be in buy territory. And then we really start loading the boat in the technology sector again. Global economy has definitely got motion sickness, and believe me, this is the most polite picture I could find involving motion sickness. 40% chance of a U.S. recession in 12 months, 100% chance in 24 months. Businesses across the board are cutting back investment, battening down the hatches, and getting ready for rough sailing. Yield inversion is freaking out global strategists. 15% tariffs hit on Sunday. U.S. consumer sentiment took a dive, and that's a big dive from 98 to 89 in August. Manufacturing PMI craters, that means people are cutting down their factory orders. And we're now at 49.1, which is recessionary territory. That means that manufacturing is shrinking yet again. The 2% GDP growth rate forecast is where the Fed is now. That's starting to look highish. Q2 was downgraded from 2.1% to 2.0. It's basically a rounding error there. Global rush to zero interest rate means confidence is in free fall. U.S. is still the strongest economy in the world, but is fading fast. Europe has accelerated a downward economic spiral that'll spill into the U.S. That has yet to come. The other shoe has yet to fall here. The imported weakness from Europe. And if Brexit is put up for another vote, it will lose, and that will be the end of that. Weekly jobless claims kind of hanging around for quite a while now at the 210, 220 range. Soybeans, no recovery there, no trade deal in sight, and now we're coming into the winter. So this is going to die off at a low level for the year pretty soon once the harvesting season is over. Bill Davis, my man, are you with me?
I'm here.
Okay, tell us what you
Joe,
got.
What's happening?
Yeah,
we're looking at a cut.
That's pretty aggressive.
Well, listen, Roku has been just on a ridiculous tear. Okay, it's every time you think it's going to sell off, it just continues higher. So I would trade it very short term off of support on lower time frame charts. What I mean by that is, you have to go to intraday charts to reduce your risk, because this is one when they pull the plug, it's probably going to be a pretty big drop. But it was interesting because I saw today was up another 6 or 7. It just keeps ticking up. It's like the Energizer Bunny. Ulta, I would take a look at that for a dead cat bounce, and I don't know if everyone's familiar, but this thing had a massive decline off earnings. Okay, I think it was down 25%. And quite frankly, that's the only thing I'd be looking for at it. Just a dead. When you usually get a drop like that, the bounce could be fairly strong, and that's the intention of that being on the list. Shopify and Costco are basically somewhat similar to Roku. I mean, both of those have been just tremendously strong stocks. I think Costco's gotten a little bit ahead of itself now, so I would wait for an entry on it. On the downside, you can see the list I have. That Schmucker, SJM, looks particularly appealing, and UNH as well. So, again, I would wait for these things to rally up into resistance and nibble on the short side.
Okay, great for that insight, and hang around for a bit and we'll go through the US charts. Let me go through the first batch of questions here Here's one. If Trump figures out the trade war will lose him the election, will he stop it? Answer, yes. And that is a risk that hovers over all short positions in the market at all times. There's another one. Do you see the British pound dropping more on the Brexit turmoil? Do you think the UK will stay in the EU? Well, if the UK ends Brexit through an election, then the pound should recover from 119 all the way back up to 165, where it was before Brexit happened. If that does happen, that will be one of the biggest trades of the year anywhere in the world, going long the British pound. And this is how I always thought it would end. I believe that, I was in England for the Brexit vote a little more than 4 years ago, and I was convinced that if they held the election again the next day, it would have lost. The only reason it won is because no one thought it would. So that brings Britain back into the EC. Not to do so would be economic suicide for the country, and I think wiser heads will prevail. Another question. Do you think it's a good idea for Saudi Aramco to go public in Japan, as reports suggest? What do you think? Well, when the Arabs want to get out of the oil business, you do too. That's what the sale of Aramco is all about. They're hoping to get or $1 trillion or more valuation, raise 100 billion in cash, and guess who the biggest investors in alternative energy in California are? It's Saudi Arabia. They see no future in oil, nor should you. This is why we've been negative on the sector all year, and this is why you should be too. Bankruptcies by frackers in the United States, by the way, are at an all-time high, another indicator that low oil prices can't be tolerated by the industry for long. And let me take a question. Time to buy the TBT? Rick wants to know, and the answer is no, not yet. I think we're going to break 133. Our all-time low will probably be somewhere just or below 1%. We probably won't go to absolute zero because we still have a growing economy. The countries that already have negative interest rates have shrinking economies or are already in recession, like Germany and Great Britain. Stocks, oops, here we go. Welcome to September. We're trapped in the middle, being circled by sharks, as it turns out. September is the worst month of the year since 1950. So far, markets are trapped between the 50 and the 200-day moving averages. That could continue until the September 18th Fed rate decision, when we'll get a breakout. Usually see an annual bottom at the end of September, beginning of October, then a year-end rally. Let's see if that holds again this year. This time it's different because everything is different. Anything that worked traditionally is not working now, and that's partly because of algorithms and partly because the market is just being hammered every day by tweets. Bearishness is growing. Surveys say investors are now 26.1% bullish, 31.7% neutral. That's the worst reading in many years. It's really the worst reading since the 08 crash. Pour the positions on whenever the VIX gets over 20. Buy every dip, sell every rally. Just close your eyes and trade. And so far, it's working fantastically well. Big long-term money is diving in to buy big tech on every dip. It's unmistakable. Every time we put out these trade alerts to buy, people jump on our coattails, and it's hard to execute. Bottom line, total of 10 to 20% down for the next 3 months, then new highs propelled by ultra low interest rates and a China deal. So Bill Davis, tell me what you see in this chart.
There's the chart. Well, look, we're in this tremendous congestion phase, consolidation phase, whatever you want to call it. And to me, it's almost like a rising wedge, okay? Just when it looks like it's going to break out, it retests the low again. So we've had, 3 retests of the highs and 3 of the lows. So the one thing I can pretty much guarantee here is that the breakout or breakdown is going to be fairly substantial. Okay, and you know they may take it higher, then move it down. I don't know right now.
Yeah,
I do have
I'm going to stick to my theory below the 200-day and the 50-day. And the end of this comes when we test the 200-day, have a 1-day fake breakdown like you saw back here in June, and then rally to a new high. But that may take several more weeks to play out. So I have another question here from a subscriber. Are you going to run all your existing positions into expiration? Well, I'm going to try to. It's only 12 days to expiration. We get to keep the full profit if we run it to expiration. And as long as the market's dead in the middle here, there are no other positions to put on. There's no extreme low to buy into, no extreme high to sell into. So, you know, partly it's a question of letting the market stay in the middle of the range and let this sort of nowhere trend play out. But also, there's nothing else to buy. So we're 60% invested now, and we're going to try and run as many of those in expiration as we can. Looks like all the long positions are safe. The only thing we're kind of pressing here are the shorts in Walmart and the Russell 2000. Okay, moving on. Dow, basically the same chart, slightly more negative. You can see here we've broken the 200-day many times, but keep bouncing back. Russell 2000, boy, it's not bouncing back. It's looking very weak. It's actually looking downtrending. I mean, Bill, what do you think of this Russell 2000 chart? Bill, you got to unmute yourself to get back in. Okay, I think
I'm back.
Okay,
Sorry about that, John. I do that to mitigate the background noise, and I know I can be a little loud here in the back. So anyway, thanks for letting me know that.
On what you ate for breakfast that day, actually.
Usually nothing, so it's not an effect of that. Anyway, the IWM, I do think it's going to be very interesting because that has, if you will, been the weakest of all these major markets. Okay, and I think it is down to a relatively strong support level. Now, if it doesn't hold, it's going to be a fairly dramatic leg down. Right now, I think what you're going to see is a lot of back and forth trading, just like you're seeing in the other indexes.
Yeah, I couldn't agree more. I just needed to hang on below 153, which is now above the 50-day moving average, for us to expire at our max profit. And by the way, this 50-day looks like it's aiming at the 200-day on the downside, so that's not good either. Another question here. Do you think it's a good idea for Tesla to build another gigafactory in Shanghai, China during a trade war? Will this blow up in Elon's face? Well, I don't think so, because the Chinese are desperate to get their hands on the Tesla technology, and they just gave Tesla an exemption on import duties on all parts they need to import into China to build the cars. So that's a very positive development for Tesla, and I believe the stock was up about $10 when that came back. Another question here from Matthew: will Roku ever pull back? Would you buy it up here? Answer: no. We recommended this thing last year at 40. It's now up to 165, and up here it's just wildly overbought in chase territory. And of course, the reason that's happening is the big concern last year is that Amazon would wipe out Roku. In the end, Amazon ended up partnering with Roku, and that's worth about a 400% gain in the stock. So, you know, the second you get into this, it's over. So there are just too many other better fish to fry in the technology area. Let's see. One more question here on the Russell. John, what happens if the Russell 2000 position closes between 156 and 153? Answer is you lose money. You will get the Russell 2000 shares put to you, which means you now own them. You'll get a big margin call for owning the extra shares. And if ever it looks like we're getting close to the strike price going into expiration, I come out because of exactly that risk. You don't want random chance dictating whether you're going to make money in your position or not. Just better to stop out. And if you're nervous about that happening at all, I would come out right now. You can still get out with a small profit. So the Russell's only up, changed today. Let's see, it's up 61 cents. So yeah, you can probably come out at even or a small profit right now. Or you could wait for another down day tomorrow. I mean, it just seems to be rotating up and down every day. So that is my answer to that. And let's move on. I'll get to more questions later. NASDAQ is also showing the same range, sort of like the S&P chart. And again, we think ultimate test of the 200-day followed by a new all-time high afterwards, like the other main charts. VIX, this is sort of a scary situation here. It's not spiking up and spiking down like it usually does. It spiked up and now it's staying up. Bill, do you have any ideas on what to do about VIX here? Is this a buy or a sell?
Again, it's kind of in no man's land, all right? I only get excited about the VIX when it gets around the 12-13 handle. It's not quite at the upper end of this range, which would be about 24, 25 area. So, I mean, to me, it's not just terribly exciting or predictive right now.
Yeah, what I'm seeing is a 50-day that's about to move up through the 200-day, and that is predicting one more sharp sell-off to go in September. So that's why I'm hanging on to my short positions. A lot of people are going to be looking at that. They may see this as a buy signal to buy the VIX and a sell signal to sell short the S&P 500. And that could be resolved in the next week or so. So let's watch this chart carefully. Could dictate how all markets go for the rest of the month. Microsoft, no one wants to sell, won't pull back any more than about $10. We're trying to get into the October 115, 120 call spread, but it just won't pull back enough for us to get it, especially now that we have an existing position already. So again, number one favorite stock in the market with a final target of 200. You don't do the options, just buy the stock and close your eyes. Facebook also just churning around the middle of a range that goes back 6 months. We're way in the money on this. This will probably be the next one I take profits on because we're so far in the money. Apple, again, holding up there very well. And again, a trade war risk is keeping me out of this one. The day they shut down the factory in China is the day the stock's down 20%. So I'd rather buy more of the other FANGs than pick up Apple at this point. It's kind of discouraging because without the trade war, Apple is announcing a new line of products in a couple of weeks. That's usually when you get a big run up in the stock. Alphabet just keeps getting sued by everybody under the sun. YouTube just paid a big fine, around $180 million. For childhood privacy, whatever that is. And so the stock's kind of churning. We took profits on this when it was clear that it was going nowhere and put that money into Microsoft. When in doubt, buy Microsoft. There you go. That's your one trade market. Amazon is at the bottom of its recent range, but holding very well at the 200-day. PayPal starting to grind up. NVIDIA, same thing. Micron also quiet because of the trade war. Salesforce got that big bounce. We caught that in the August expiration, and now we're back to churning sideways again. Boeing still waiting for the recertification. Rumors flying left and right. They'll be back in the air by the end of the year or not. Any runs down to 330 or so, I'd be a buyer of the stock, and I'd probably be a buyer of the call spread like the 270-300. Earn you about 10% a month doing that one. Walt Disney also hanging in there. That's the next Netflix. and we're probably going to run this into expiration also. Adobe, we have a long in the tech letter on this one, and again, holding up very strong there. Industrials, avoid like the plague, going nowhere. They seem to be the big American victims of the trade war. And US Steel, a disaster, down 50% since the election. Nobody wants to buy US Steel anymore because it's too expensive. Walmart trying to break out. And if we do decisively break out of that double top there, I'm going to cover my short, take my profit there, and save my money for another day. We're getting close to take profit area on the upside. This is potentially another FANG. That's the bull case, and we are not inclined to take losses. Remember, at this stage of the game, up 36%, protecting profits is now the main strategy in the market. Macy's, new lows, tried to sell that. Again, just couldn't get the entry point. Tesla hanging in there, not really doing anything. And Southwest Air also churning. Delta, same thing. Transports, don't want to touch. Healthcare, kind of dying in the middle here, but it's relative cheap to the rest of the market. So not only are we going to start recommending healthcare stocks, we're going to launch a healthcare newsletter. How about that? Just waiting for the right market timing to do that. Goldman Sachs financials are dead. Palo Alto Networks sell off on the earnings. Consumer discretionary trying to grind up with the market. Europe dead in the water. Japan deader in the water. And emerging markets killed by the strong dollar. Let me take a few more questions here. Let's see. Let me read this real quick. Is it time to get super aggressive shorting Uber and Lyft when they admit that they won't make a profit anytime in the near future? The time to short Uber and Lyft was at the IPO, as soon as the shares became available to sell. Down here, I really don't want to do very much. It's late in the game. Uber's down about a third from its IPO price. We beg people to stay away from this. It's another example where they waited for the company to go X growth before they went public and didn't leave anything for the public. So very badly mishandled IPO. It's now at 31. Yikes, against a 45 IPO price, and new all-time low just 2 days ago. So yeah, someday this will be a buy, but not yet. Okay, moving on. Let's see, bonds still exhausted. We've kind of been churning between the 145, 152 yield level on the 10-year, and waiting for some new disaster to take us to new lows in yields. Just wait, the disasters are a dime a dozen these days. So that's giving us a short-term peak in prices, bottom in yields that has to be worked off. Could take a while to work that off. And by the way, the Fed interest rate decision on the 18th also is a good target on your calendar to get some movement there. Some $3.1 trillion in negative yielding bonds were created worldwide in August. Yikes. Talk about pouring gasoline on the fire. 16 billion poured into bond ETFs last week. 40% of the world's bonds now have negative interest rates. German bonds negative 90, Japan negative 25. So, looking for the bonds to go below zero in the next recession, that you want to refi your home. By the way, if you refi your home now, you'll get a huge interest rate savings. And if we go in recession, you'll be able to refi again in another 18 months when rates finally hit zero. So it could get to the point where house ownership is free. And when I say free, your Interest rate is below the long-term inflation rate, which means that at the end of the 30-year loan, you own the house and got it for nothing because your interest rate was below the inflation rate. Here's the TLT struggling to make new highs again. 10-year yield, we got a low of 144, maybe 143. Junk bonds spiked up on the latest rally. TBT, don't want to touch down here if we're headed to new lows. And the emerging markets, again, getting destroyed by the strong dollar. Again, muni bonds, new highs. Foreign currencies, new highs for the buck. And yeah, you do a Google search on buck and that's what you get. US dollar takes another run at the highs based on economic strength and stalling rates. 3 more interest rate cuts by 2020 now in the market. Whenever markets ignore interest rate differentials, the move is short-term only, but we could go a lot lower in rates, a lot higher in prices. British pound bouncing hard on the possibility of no Brexit, which will happen if they have elections in October, which now are expected. Chinese yuan falls on Hong Kong instability. So let's see how that plays out. And Bitcoin is also stalling. So keep selling the buck against everything. We should be turning soon. Japanese yen is up here. Euro new lows, yikes. And that's on the deteriorating economic situation. Again, I tried to sell the euro, we never got a lot above that 50-day moving average, so I never had a chance to sell. Aussie dollar, we got a new low, but it seems to be bouncing today on the positive Hong Kong news. So I really think we're getting a decade turn in the market soon on the Australian dollar. Just hang in there. Moving on, yeah, emerging currencies also, like all other emerging assets, are getting killed. Chinese yuan, new low there, trying to offset the tariff increases. And Bitcoin kind of going nowhere. The action is elsewhere, like technology stocks, for example. Okay, let's take some more questions here. The fact that rich people are hoarding cash is a good indicator that a recession is approaching. Answer, absolutely yes. I went to the Pebble Beach Concours d'Elegance a couple weeks ago, and they had the worst car auctions in 10 years. Turns out the market for $10 million cars kind of shrinks right before a recession, because the people who got rich spotting recessions, by the way, don't want to play anymore. All of the action was in cars under $100,000, and that tends to be entry-level, first-time collectors. So, yeah, and also bonds, yielding 145. That also is an indication that the wealthy are hoarding cash and parking at U.S. Treasury bonds, as they have done for many, many years now. Let's see. Here's another question. Argentina just implemented currency controls. Is this the start of a rolling currency crisis among emerging nations? No, I think the problems are unique to Argentina. They won't spread worldwide. And what's happening in Argentina is they adopted what is known as modern monetary theory, i.e. borrow like crazy, print money like crazy. Unfortunately, if you pursue that long enough, you end up with a currency crisis, a devalued currency, and general instability. And by the way, that is the economic policy we are pursuing now in the United States, maxing out borrowing, running giant deficits in the hope that it'll eventually devalue the currency. So be careful what you wish for. Energy, we have a supply glut. Saudi Arabia looking to cut production. Russia producing above quota. Massive tax subsidies driving new investment in the U.S. Largest buyer of U.S. oil, China has banned U.S. oil as part of the trade war. Geopolitics having no positive impact. So really, same old story, not much to say here. We look for $42 a barrel in the short term, and 25 in the next recession, maybe lower. Okay, oil, yeah, there's your chart, and the whole oil sector just looks like it rolled over and died. There's the USO. The energy stocks have done worse, and a lot of these are very high dividend yielding, like Exxon. The trouble is those dividends are not printed in stone. Be careful what you buy. If they cut dividends in the energy sector, the stocks will drop by half very quickly. Halliburton, new lows. Nat gas, getting a little rally yet, and that's partly because of the hurricane that's hitting Florida, has disrupted the distribution network. I expect that to give up fairly quickly. Precious metals still in play, and again, silver finally has moved to the forefront as the big mover. Traditionally, this always happens. It was just late kicking in this time. I don't know really know why, but we're down to 82 to 1 on the gold silver ratio. That's down from 93 in July. Investors bought 101.4 metric tons of gold in August, the 6-year high. Trade war has given the yellow metal an extra spin because the collapsing yuan is generating more than usual Chinese buying. We're also about to enter the traditional Indian gold buying season. Catch-up plays in silver, which only started a month ago, and has soaring industrial demand because of solar panels. Yes, every solar panel has a little bit of silver in the wiring, and the more panels get consumed here, the greater the silver demand. It's almost got to the point where we replaced film as the largest demand for silver. Remember black and white film? You needed silver nitrate to help develop it, and when we went to digital cameras, the demand for silver just completely fell off a cliff. So what's happening is reverse, and that is a very long-term industrial demand for silver is coming back. Bottom line, buy the bigger dips in gold and precious metals if you can. Trouble is they don't pull back. They're impossible to buy. Okay, so Pablo, that answers all your questions on gold and silver. Okay, let me take a look at a couple more questions here. Okay, we got that. Yeah, let's see, I've already covered that. I wrote about the Porsche Taycan in this morning's Hot Tips. It's not a threat to Tesla. Their cheapest car is $150,000, and it gets 1/3 less the mileage that a Tesla does. So only Porsche devotees will buy that car, and once they all own the car, there won't be any more demand. And in the meantime, Tesla's taken over the middle part of the market with the Model S. So they've already sort of surrounded Porsche and taken over the market. Porsche will never have a low-end car, just a few purchases of the high-end car by collectors and Porsche fanatics. Yeah. Here's another good question. How will the U.S. pull out of recession if interest rates are at or below zero? Answer, it won't. And that's what a lot of economists are worried these days. Ray Dalio, the hedge fund legend, was commenting on this last week. With interest rates below zero, the Fed has lost its primary means to stimulate the economy. And the only thing left is to do creative stuff like flood the economy with currency, which Europe has been doing for 10 years with no results, and Japan has been doing for 30 years. So yeah, that's a big question, and that, by the way, is another reason for them not allow them to get back to zero, so we have tools to use in case we do go into recession, which is just either 12 or 24 months off. So let's finish our precious metals talk here. Let's see, sparkling hoard. Yeah, this shows the amount of gold going into gold ETFs. and you can see we're at a 6-year high right here, about to hit an all-time high. The other thing you want to worry about is that we get up to the old high, which was 7 years ago, you might start getting profit taking, and gold could peak out there. That means gold peaks out in about another $50 or $100. So be careful. We may be getting to the end of this move. Here's your gold silver ratio. You can see it's collapsed here from July. That is usually a bullish signal for the market. There's your new high in gold. Same with the GDX, the miners, and a great play on the miners there. We've been recommending them really all year, and we've gone from 21 to 30. So that is nearly 45% move since May. Not a lot of things have gone up 45% since May, and the trade war is a big part of that. Barrick Gold, again, new high on this move, and that's almost a double since May. Newmont Mining also doing well. It's about 35%. And silver, you can see, is just suddenly taken off like a rocket in August and seems to have $20 an ounce in its sights. Silver miners doing even better. Wheaton is a great silver royalties trust where you're buying the income stream off of the world's largest gold miner. And that has also been another classic silver play with a very high yield, by the way. There's palladium, copper bouncing along the bottom. Freeport-McMoRan bouncing along the bottom. Real estate still sliding. July existing home sales were up 2.5% to 5.42 million units. Foreign investors have become net sellers of U.S. commercial real estate, anticipating a recession, down 37% year on year. Canada, Germany, and Singapore have been the biggest real estate investors. And Singapore, obviously, that's an offshore vehicle for mainland China. July pending home sales down 2.5% despite ultra low interest rates. Tappable equity, there's a new concept for you. It's a new all-time high at 6.3 trillion is the amount that can be pulled out of a refi and leave 20% equity. That means the home ATM is back, and that will emerge as a major support for the economy in coming months. And if we don't actually have a recession, just a growth recession or earnings recession, that will be the reason. 6.3 trillion buys you a lot of economic growth. May S&P Case-Shiller, we're down to 2.1% annual gain now. We're probably only a few months away from seeing actual declines nationally. That's the lowest gain in 6.5 years. There's the Case-Shiller. Rate of gain in the individual cities also falling fairly rapidly. Phoenix is number one, followed by Las Vegas and Tampa. We've had the top three cities being the same for the last several months now. By the way, these are also all your subprime cities, the ones that led the last crash. Same property group, REITs, still not getting any joy from low rates. Again, recession fears driving down mall groups. Home construction, this has been remarkably strong and seems to be immune to any sell-offs, and that is anticipating the giant wave of new home purchasers we'll get from millennials in the 2020s. It's making that move early. So trade sheet, what do we do about all this? Stocks, you want to sell rallies. Bonds, you want to buy dips. Commodities, stand aside. Currency, sell the dollar against Aussie, Euro, and now the pound. The pound is back. Let's see where we are here. And we are up 200 on the Dow still. Precious metals buy dips, energy avoid, volatility buy dips, real estate stand aside. And the next strategy webinar is on Wednesday, September 18th, and I will take a few more questions. Let me see what has come through here. Best way to buy silver is the ETF, SIL. And if you want to be aggressive, buy the silver miners, SLV. Okay. Okay, got that. Okay, don't have an opinion on that. And don't have an opinion on that. Let's see if we got any more questions that come in by email. Here's a good one. Have global central banks ruin Western economic system as we know it for future generations? They may have by printing too much money in the last 10 years to get us out of the last recession. Hasn't really worked for Europe or Japan. Of course, if they hadn't printed money, who knows how bad off they'd be now. What it did do is here is head off a Great Depression. However, if we go back to money printing in a big way and it doesn't work, we haven't prevented a Great Depression. We just moved it forward 10 or 15 years. So that is the great debate going on among economists, and it'll eventually be settled by the marketplace. Who knows? Okay, well, that is it for today. This is John Thomas, the Mad Hedge Fund Trader, signing off for today. Good luck and good trading.